We also have this Mayuresh Joshi, fund manager at Angel Broking. Mayuresh, we've been trying to dissect, understand what's happening, but I guess it's beyond our minds to comprehend the kind of volatility that the markets are currently witnessing or the picture that is playing out. Market breadth has panned out very weak. Small and mid-cap index is clearly in a bear territory. Yesterday, we believe there was heavy PMS selling that the markets witnessed. What are your clients telling you? How concerned are your retail investors? I mean, what are you telling them? What should they be looking to do? Because most retail investors own a number of small and mid-cap stocks which are now trading at their 52-week low for a lot of them.
So morning, Samina. No, I think so. The market has been through a whole host of issues. To begin with, what happened in terms of the global trade war fears, and those fears probably coming true at this point of time. The other element in terms of crude prices still remaining at elevated levels. And again, I think the flight of safety towards the dollar. So I think you've probably seen the Indian rupee, along with a lot of emerging currencies, actually depreciate a significant amount against the dollar. So I think all these apprehensions are probably playing out. On the other hand, on the domestic front, you're probably looking at battling with inflation, though I think food inflation should start cooling off in the second half. But again, I think the crude movement along with the rupee depreciation movement is going to get cause concerns and headwinds as far as a fiscal deficit and a current account deficit are concerned. So a large bit in terms of how the markets have also panned out in terms of a lot of auditor resignations. You've probably seen that create a lot of panic within the mid-cap universe. So I think sticking with quality, sticking with good quality large cap names or good quality mid-cap names does make sense in the markets. Is markets going through a phase of consolidation, probably concerns? Is the sell-off probably much more than what we warranted? A large element is that sentiments are dampened on the street, not just domestically, but also globally. So to that bit, I think from a near-term perspective, markets will still struggle to find its feet. But I think quality should stand out from a long-term perspective in these markets.
I mean, unfortunately, Mayuresh, quality is not standing out for now with these.
So, Mayuresh, you're bleeding heavily in the markets, especially on the OMC front. Of course, there are also macro indications for this, but as far as stock-specific action goes, I mean, what's going on?
No, to a large element, Dipanshu, I think if you look at how the oil prices are hovering at this point of time, and if you look at the rupee depreciation against the dollar, obviously the sensitivity to earnings, specifically from these two key variables, do hit the earnings profile for OMC companies. Now, a large element in terms of FY19 and FY20 earnings have been centered around crude prices between 65 and 70. Now, if they hover between 75 and 80, that $10 spike is going to take an EPS hit. The second element obviously is with rising crude prices, whether these companies will be able to protect their marketing margins. So to this extent, I think the oil minister has probably still given a freeway to oil marketing companies. But if it still keeps on persisting at higher levels, how much sustainability will the marketing margins have is also some amount of headwind that these companies are facing. The third element also becomes in terms of the GRMs in parts of the refining business. Now the product cracks, specifically in the middle range, have been extremely strong and stable so far. And that's the whole premise that the distillate yields will probably hold up. But how the movements happen specifically in terms of both naphtha, in terms of diesel cracks, is going to be very, very interesting over the next few weeks in a scenario where oil prices keep on sustaining at elevated levels. So I think all the aspects of their business in terms of refining, petchem, probably do get hit. Though on the petchem front, I think because crude probably stays on a higher level, the end product realizations obviously move up. But then the other variables in terms of the capacity expansions that they are doing, how sustainable their cash flows will be, and whether they'll be able to fork out the same dividend yields is also going to be an interesting perspective. But my perspective is a large element has got gestated in. I did not expect such a brutal fall probably in the last few days. But largely I think this is something where you can probably take it from a bottom-up perspective. So I think any significant declines onto a counter like IOC, in my opinion, if somebody genuinely has a long-term view, can be actually be taken as a contra bet.
All right, so maybe IOC could be a contra bet, but of course you will need to have a higher risk appetite for that. Mayuresh, fundamental case for an M&M, especially after the kind of returns it's given in the last 6 months. Does the risk reward favor this one?
So I think in markets like this, Dipanshu, I think one really needs to understand how one's risk reward perspective is. But having said that, I think in terms of its core business fundamentals, the farm equipment segment has been doing exceptionally well for M&M. What you're probably talking in terms of volume growth of 9 to 10%, I think that's going to be a significant accretion in terms of not just their market share, but also assuming and ascertaining that the farm equipment revenue growth should be quite sustainable and stable. On the UV part of the business, I think the expectations in terms of few key launches, the expectations of coming out with remodeled versions of their old cars, I think that is going to be a very interesting perspective on that segment of the business as well. In terms of Sayong, I think the kind of synergies that one really expects to come through and get built into the business can also be evident over the next few quarters. On the fourth perspective, in terms of the investments made in a lot of subsidiaries, I think a few of the subsidiaries are doing exceptionally well. So I think Tech Mahindra is doing exceptionally well. You're probably talking about the sum of parts coming through the subsidiary valuation, also having a significant say in terms of the share price. So from a long-term perspective, we obviously remain very, very sanguine in terms of expectations of financial performance that the company can deliver. And our expectation is that it can deliver a very strong earnings growth. So yes, I think the stock might have moved up, it might have sustained this fall. But again, I think if numbers come in place, my own sense is that the stock can move and head higher over the next few quarters.
Right, that is an M&M.
Mayuresh, any of these cement stocks that you're buying? Because till yesterday we were talking about how directionally the trend had changed. There were a couple of brokerage upgrades as well, where people were talking about pricing pressure has bottomed out. Stocks like Ramco, Shree, Ultratech were top picks by CLSA. Would you use this current weakness to recommend cement counters to your clients?
So again, I think the view here is that if you probably look at how the cement offtake has been, the south of the country obviously has got impacted because of sand mining issues, petcoke prices moving up, and the inability to probably pass on the prices in terms of realization hikes. I think the central part of the country and the northern part of the country have held up pretty well. And again, the expectations largely in terms of at least this quarter and the next, quite a little bit subdued because I think the monsoon season will be on. So I think the offtake probably will be a little bit lesser, except Q1, I think, where you probably might have better offtake taking place. But I think Q2 might be a little bit soft for these counters. On the other hand, I think because of the push that you've probably seen in terms of input cost inflation, both because of petcoke price movement, you've probably also seen diesel prices move up, which means the freight element in terms of your overall cost moves up. And again, I think the power-related costs still have a significant amount of say in terms of how the EBITDA margins pan out. Having said that, I think cement companies with a reasonable amount of capacities operating out of these regions in central, catering to the north or the west, in my opinion, should keep on doing well. Again, I think in terms of utilization levels, it's around 70-75%. It should start inching up gradually in the second half because there have been a lot of government initiatives and that should actually start bearing fruit in terms of significant offtake that these companies can do. So I think the natural leverage on their balance sheet should gradually start playing out. Yes, there have been certain reports in terms of capacity additions that the industry is going through, but I think they're going to be very, very gradual over the next few years. And that should ensure that the capacity utilization above 80% is a sustainable factor. Having said that, I think the large cap names, probably with larger volume growth, say the instance of Ultratech, the sweating of their JP assets is going to be extremely crucial. They're probably doing that in the right direction. Again, I think price hikes, realization growth, extremely critical to probably maintain their EBITDA margins and have sustainability on EBITDA per ton. Valuations might be on the higher side, but I think the whole recommendation on Ultratech continues. Within the mid-cap universe, JK Lakshmi Cement is probably something that I would favor at this point of time, more or less with expectations of volume growth between 10 and 12%, margins improving from the 12% that it is posted. And the cost optimization efforts because of the waste heat recovery at Durg, the conveyor belt, ensuring that the EBITDA per ton also gets maintained at these levels and improves hereafter. So I think $82 on an EV per ton on FY20 looks reasonable at this point of time.
Right, that is Mayresh's view. Right, let's get Mayresh, Jay, Gaurav as well as Hemen. Thanks for your time this morning and running us through your reading. Little bit of a recovery coming in, or rather little bit of stabilization